Are you planning to pass assets on to your heirs through your current IRA or 401k? Many Americans have saved for retirement in these tax deferred vehicles and plan to use any excess funds in those accounts as a legacy for their heirs. However, there can be some tax implications of passing your legacy on to your heirs through an IRA or 401k. And those tax implications could potentially mean your heirs pay more taxes than you planned. Let's look at two common reasons. The first is if you are a couple and one of you passes away, the surviving spouse's tax brackets change. Your surviving spouse will go from filing joint and married to potentially filing as a single filer. And that means even on the same amount of income, their taxes have gone up because those single filer rates are higher than the joint rates. This is often referred to as the widow's penalty, and it just means that the surviving spouse's taxes could be higher than you planned. The other common tax issue with passing legacy on through an IRA or 401k is what we call the 10-year tax trap. Now, in 2019, Congress changed the rules of how your heirs can access funds from an inherited IRA. It used to be that for most people that inherited, let's say, their parents' IRA, they could access those funds as they saw fit. Many inheritors would stretch out those IRA payments. They wouldn't want to access too much income in a given year because, of course, that extra income could bump up their taxes at an inconvenient time. Well, in 2019, the rules changed. Now, for most savers inheriting an IRA, let's say from their parents, they are required by law to fully drain and pay taxes on that account within 10 years. And what this means is that your heirs may have less flexibility to manage when they take that additional income from your IRA that they've inherited and pay taxes on that income. The challenge with passing a legacy to your heirs in an IRA like this is also that legacy money tends to be taxed at your heirs' highest tax rate. As you know, in the United States, we have a graduated tax bracket system. So for your heirs' general income, some of it is taxed at lower rates and some of it is taxed at higher rates. But because your legacy assets are coming to your heirs on top of their existing income, it means all the funds that they're pulling over those 10 years from your IRA are taxed at their top tax bracket rate or potentially even higher if that income pushes them into a higher tax bracket. This is one of the many reasons that savers are looking at the tax status of their retirement assets. If you think that tax-free legacy assets for your heirs may be more beneficial for taxes for you and your heirs than these tax-deferred vehicles like 401ks and IRAs, now is the time to evaluate the options. Let's look at the tax potential in your current approach for both you and your heirs, and whether it would make sense to instead house some of those funds in a tax-free vehicle like a Roth or like life insurance. This is a critical conversation to be having this year because taxes right now are a little bit lower after that One Big Beautiful Bill Act passed. So if you need to change the tax status of your legacy assets, this could be the time to do it. Make this year the year you evaluate how to best minimize taxes for you and your heirs, and of course, maximize that legacy you've worked so hard to save and pass on.